Awesome. Awesome. All right. Um, Good morning, good afternoon, good evening, depending on where you are. My name is Edward Karani from Gochapaa, and today we are hosted in Web3 Club Space. So shout out to Web3 Club Space for giving us this space to do our podcast today. And I'll start by apologizing for being um, have delayed to start this podcast. But we'll try and finish up within the next 50 to 45 minutes. So, yep. So we are broadcasting this live on YouTube, I believe on other channels as well. So in case you would want to interact with us, please leave your comments, react with emojis as well, make notes, maybe drop us some notes on other channels as well, Telegram, Twitter, and LinkedIn. And yeah, let's get to it. So today we want to dissect some of the recent developments in Web3, blockchain or crypto space, specifically with regard to regulations. And joining us today is a man who doesn't need a lot of introductions in the ecosystem. But for those who doesn't know Kaikai, I'll let him introduce himself. Kaikai is from BAK, and also we have Sam Kim, who is our founder at Gochapaa. So perhaps we can start with you, Kaikai. Yeah, so some maybe brief introduction.
Thank you very much, Edward. My name is Kakai. I have a background in law, born and raised in Kenya. For the past couple of years, we've been deliberately sharpening or rather opening, trying to find ways to open up the markets to the grander market and to policy guys to create an enabling environment for virtual asset businesses to thrive. That landed us to last year where we extensively doubled down and we hit a very good milestone as far as virtual assets lobbying is concerned, which led us to the drafting of the first ever virtual asset service providers bill, the first draft of it. And yes, very excited to be here. And I think I'll cover the details of the journey that got us here later on in this podcast. So yeah, thank you very much for hosting me, Edward. Thank you very much, Sam, for joining us.
Super. Sam?
Yes, hello. My name is Sam Kim. I am the founder of Gochapaa. I am born in Korea, raised in Kenya, now back in Korea. And as as crypto becomes sort of accepted, and there is a downstream regulatory framework that needs to be dealt with and worked with in cooperation with obviously the regulators, the moderators, and the actual startups that are involved in the framework of crypto. Obviously, as you know, crypto involves a lot of different kinds of regulatory and legal framework. It's not just a simple digital asset. It hinges on a lot of capital market regulations. It hinges on a lot of the current existing banking laws. As you know, it could be a disruptor. It could be welcoming. It could be, there could be some frictions. So going forward, there's going to be a lot of discussions such as today that we're having. And I look forward to having a lot more discussions for various audiences. So not currently, obviously in Kenya, there are only developers and people who are already in crypto, so to speak, that are very well aware, and they're just anticipating a lot of good, positive news flows regarding crypto regulatory framework. However, going forward, I foresee that a lot of the retails, a lot of just the regular people who maybe had no easy access to financial securities, financial products, being offered such products and investment opportunities. So that I foresee there's going to be a lot of work to be done and a lot of discussions going to be done. So I'm very happy to kickstart this with Mr. Kakai, and I'm very happy that we are working with regulators and with moderators within the legal framework. And I foresee that there's going to be a lot of good discussions starting from today. So thank you for having me.
All right. Thank you, Sam. I know we've kept you late in Seoul. Thanks for joining us today. So I'll start with Kakai. And first of all, really like to thank Kakai for the incredible work that they did with the Blockchain Association of Kenya team for drafting that virtual assets providers bill. You guys did an incredible job. So perhaps we can start with maybe giving us a status update of where we are at the moment, and maybe a brief timeline of how we got there.
Yeah, very good question, very interesting. Where we are at the moment is there's a draft bill, Parliament. There's a technical committee established by the National Treasury that is looking to review the bill, of course, and they'll also have the input. And interestingly, the United States has just also passed their own version of virtual asset bill called the FIT 21. So that is where we are. Now, where did we start as Kenya? I'm going to break down a timeline of how we started out. And in this timeline, I'll also specifically call out key players, which Sam has already sort of alluded to, the key regulatory players who have been part of this journey with us. So, of course, crypto is not a new thing in the Kenyan community. And even Kenyan regulators interacting with crypto, it's not a new thing. It's the first time ever that a Kenyan regulator interacted with the crypto from a regulatory model perspective was in 2015, where the Central Bank of Kenya, the CBK, issued a cautionary notice restricting banks, financial institutions, microfinance institutions, SACCOs, and key players that are under CBK's regulatory mandate, restricting them from interacting directly with cryptocurrencies. And that paper specifically called out Bitcoin and other currencies, given the nature of their risk. Now, before 2015, crypto companies in Kenya will be able to set up accounts, will be able to set up M-Pesa APIs, and so on and so forth. But immediately after that cautionary notice, crypto companies were no longer able. To date, it's a 9-year-old cautionary notice. To date, no crypto company is able to set up and operate Kenyan bank account as long as your primary business is buying and selling of crypto, exchange swaps. You're not able. That means exchanges don't have Kenyan accounts, custodial wallets cannot be able to do accounts, and so on and so forth. So that was the first time ever that the first ever regulator, the Central Bank of Kenya, came into the picture. Then later on, a few years down the line, 2018, 2019, we saw an attempt of doing the first ever initial coin offering in Kenya. I mean, in 2018, 2019, everybody was trying. The biggest business use case for crypto during those days was ICOs and stuff like that.
Yeah.
So a Kenyan tried his fair share of the luck in this ICO game. Locally tried to do an ICO of a coin called Kenny Coin, which was issued by a company called Wiseman Talent Ventures around 2018, 2019. Now, when this happened, because the Capital Markets Authority comes in and issues some sort of public also cautionary notice restricting Kenyans from purchasing or participating in this ICO. So now here we've seen two regulatory authorities come into play. We've seen the CBK first time, then CMA. The reason why CMA comes in is because CMA is the regulator of the securities and commodities market. So conventional in traditional finance, if a company is doing an IPO, initial public offering, they would usually go through CMA.
Yeah.
So when this Kenyan coin, Kenny coin, was being issued as an ICO, then the CMA took it upon itself to find that its mandate now will also extend to such kind of product, because from a juxtaposition perspective, the nature of an ICO will be sort of the nature of how an IPO will be done.
Yeah.
Now the CMA blocked this ICO by Kenny Coin, and what the Kenny Coin guy does, he moves to court to challenge, seeking an injunction restricting CMA from interfering with his business. And now a third player comes in. This is the first time ever we are seeing a jurisprudential question, a matter before court, when it comes to dealing with virtual assets. The first time ever the Kenyan High Court is being presented with a crypto case. Now, the issue was the Kenyan court, first of all, had to classify what category will cryptocurrencies fall in for it to then inform a decision that actually, if it's a security, then CMA is entitled to regulate this. And if it's CMA is entitled to regulate this, then CMA has the mandate to stop your ICO. Given that there was no jurisprudence in Kenya around cryptocurrencies, and as a matter of fact, there was no jurisprudence in short, historical cases around this, the court had to refer to a US test called the Howey test, which is basically a taxonomy test used to classify as whether a product is a security or not. Sort of a 3-4 tier test whereby is it being offered to the public? Is it being offered by a centralized entity? And is the public being invited to participate in it for profit? So now, based on that test, the Kenyan High Court ended up classifying virtual assets, cryptocurrencies as securities. And based on that classification, the CMA was concluded to be the authority with the statutory mandate of the Capital Markets Act to regulate security-like assets. And that is how the CMA was allowed to block that ICO. So up to 2019, we are seeing 3 government agencies. Number 1, the Central Bank of Kenya, 2015. Number 2, the CMA, issuing a cautionary notice. And number 3, a Kenyan court, whose mandate is to digest a jurisprudential question when it comes to a dispute on virtual assets. Now, interestingly, also right around 2019, a task force was formed. Now the Ministry of ICT comes in. They formed a task force called the Blockchain and AI Task Force, which was chaired by Professor Ambassador Bitang Ndemo, a very sharp gentleman. And the idea behind this task force now, created by the Ministry of ICT, was to understand the risk parameters around virtual assets and to explore whether there will be a possibility of adoption of this thing in the future of Kenya and where this lies in the grander scheme of things. Task force did a series of interviews, interviewed a bunch of private sector players. A lot of guys from the Blockchain Association participated in those interviews. And the conclusion generally was this thing is not going away anytime soon. So it's just about developing clear regulatory frameworks to build safety nets. Number 1 being consumer protection. Number 2, seeing how government can adopt this, and even a light touch on tokenization and how the government itself can be a beneficiary of this technology. So right around the same time, the CMA rolled out, launched the Capital Markets Authority Sandbox, the CMA Regulatory Sandbox. And the idea behind the sandbox is usually to create a playing field where a test room whereby if somebody is launching a product that is not that is operating in the shadows or in a gray area of regulation, whose regulation is not clear per se, then then a sandbox will be able to nurture and incubate that product while the private sector and the government figure out the clear safety nets and regulatory parameters around such products. Now, a lot of guys in the crypto industry were very excited. I mean, a sandbox has been launched. Let's send our applications.
I think that was a very good opportunity for them to test their product and
exactly
the market.
So what do? They send the applications. Then the CMA declines the sandbox application at that time. Now, the reason for that declination was published in the CMA milestone report of 2021-2022, where they were saying they were unable to onboard crypto exchanges and crypto companies, given number 1, the lack of internal knowledge for that. Number 2, the risk parameter, the risk depth and breadth of this area is just crazy. And the underlying justification behind that report is that the Capital Markets Authority at that particular time was not ready to onboard crypto products, the sandbox. Now that leads us to late 2022, December, where now we see the government again coming, having a convention in Kisumu. This convention is usually an annual convention done by the Joint Financial Sectors Regulatory Forum,
They
JFSR.
includes CMA, CBK, and the rest.
Yes.
Okay.
And now they look at all this history, and now they're seeing data from chain analysis and all that. They're saying crypto in Kenya is being transacted in billions of dollars. This is an elephant we can't avoid. So in their annual publication, they made a commitment to regulate virtual assets. A few months later, that is 2022, so a few months later, 3-4 months down the line, we saw KRA come in. Okay, of course, a bill was tabled by the National Treasury, the Finance Bill for 2023. And this Finance Bill has introducing something called the Digital Asset Tax. So now we are seeing the fourth government player coming in. Just to recap, we had CBK, we had CMA, we had Ministry of ICT, we had CMA Regulatory Sandbox, we had the JFSR, and now we are seeing the KRA coming in through the National Treasury, of course. And they presented a bill in Parliament, which was part of the Finance Bill, amending Section 12F of the Income Tax Act, which wanted to introduce some form of income tax on digital assets. Now, tax is fine. Of course, tax and debt are inevitable.
I remember the biggest issue in the industry is you want to tax an asset that you don't legally recognize. Ordinarily, you would expect to see some sort of regulatory framework on such assets before you even tax them. Yes,
that was the first issue. Yeah. Guess what issue number 2 is? CBK has banned these guys from holding bank accounts. So in the highly likely event that an exchange or wallet was to withhold this tax and pay it, how will they actually pay the tax? So that was also a big issue. The implementation of the whole tax thing. Then leads us to a third issue on the issue of an income tax is meant to be a tax on profit. You know, a lot of us in this room usually hold Bitcoin because when it moves from 20K to 70K, we've made a 50K profit and we're comfortable paying income tax on that.
But it doesn't go that way always.
Yeah, it doesn't go that way always.
And lose as well.
Yeah. So what happens is, what about if I bought it at 20 and I'm selling at 15? I'm making a 5K loss already. In principle, I'm making a loss. It's unconstitutional to tax me when I'm in a loss-making position. Right. So we took these arguments to court around August, September of last year. The matter is still pending in court, so I will not get deeper into that. But so up to this date, you've seen various government agencies partake in trying to have their fair share on how they approach this market. So also right around that time, the Parliament of Kenya now comes in. Now this is the 7th body. Parliament of Kenya, specifically through a parliamentary committee called the Parliamentary Committee of Finance and National Planning, chaired by Honorable Kimani Kuria, who is the Member of Parliament from Molo, a very sharp gentleman, by the way.
And BAK made the presentation.
And we made several presentations to them. The first one was on tax, but we made a second presentation, the third and the fourth. And by the time we were getting the second presentations, they're the ones who told us, look, you guys seem to have a very detailed and thorough understanding of this thing. How about you guys do a first attempt of a virtual asset service providers bill? Then we will pick it up from there. So that is how BAK ended up Q4 of last year, leading the initiative of drafting the first ever virtual asset service providers bill. This is a very historical moment because for the first time in the tech space, we are seeing a regulator telling private sector, draft your own stuff, we'll take a look at it. So a big chunk of Q4 last year was spent working, and then you are part of a lot of our workshops and a lot of other guys just figuring out what goes into the bill and what does not. And during that time, we had calls, community calls, both locally and globally with guys from South Africa, Dubai, Singapore, and a bunch of guys from the US just want to figure out what is the best case scenario. Of course, we narrowed down to, okay, this industry is very big. You can't claim to regulate everything. I can't claim to write a bill that requires Bitcoin to have a license, but I can do a bill that requires a centralized exchange to have a license. So we narrowed down to centralized bodies, 4 key licensing categories, number 1 being exchanges, number 2 being on-ramp, off-ramp providers, number 3 custodial wallets, and number 4 token issues. So simple, neat licensing regime that is straightforward. Then we'll figure out other licensing regimes down the line. So we submitted the bill earlier this year, and right around the time, Treasury appointed the technical working group, who all members of the group received their appointment letters around April of this year. So the work has not yet started yet, but the mandate of this technical working group is, of course, to look at the draft bill and do comparative analysis and just find a way that they can redo it in a version that has government and the regulatory interest.
Yeah, but hold on. But what happens to the earlier committee, which was formed by the JFRC? Is it still?
Yes, so members of this technical work,
Okay.
the National Treasury, forming members of the JFRS are still the members of this technical work group.
Okay.
So this technical group has one rep from the CBK, one rep from the CMA, NIFC, IRA, and all that. These are still the same members of the Joint Financial Sectors Regulatory Forum. Right. So they're the same.
Great.
Oh, one thing I forgot to mention. We also did a survey, risk assessment survey with the Financial Reporting Center last year. I think you remember it.
Yeah.
Right around September last year. And the idea was just to do a pulse check on the anti-money laundering and counterterrorism finance risk that virtual assets present. This was very important because a few months later we saw Kenya being relisted because of AML risk. But of course, virtual asset was not the reason, but probably having a clear regulatory framework will help mitigate the issue. But it's usually the grand scheme of things. So that is the length and breadth of thing. You've seen how the executive comes in, the parliament comes in, and the courts come in figuring out this monster of virtual assets.
Super. That's a very detailed timeline of our events. We'll come back to that vast bill and see what it entails. For now, perhaps we can switch to Sam. And Sam, could you give us an idea of what's happening out there in other jurisdictions?
Sure. So I was invited by Consensus in the US last year to discuss. I was a panel speaker, and I was invited to speak about the global framework and where the crypto hubs, meaning where the regulatory framework is more favorable to crypto. As you know, at the time, the ETF was not approved. Halving didn't happen. A lot of these uncertainties didn't happen last year. As opposed to now, we have a lot of the uncertainties that has happened. And now we're also looking at SEC possibly approving Ethereum spot ETF, which is something that a lot of people weren't expecting. The reason why I bring this up is on the global scale, the current regulatory framework is playing catch up. And the speed, and Mr. Kakai mentioned this brilliantly, that there's so much to study and there's so much to catch up. However, the technology is moving too fast, even for the developed countries' regulators. Currently in Korea, the Virtual Asset User Protection Act, which was actually written last year, is getting implemented in July of this year. However, half of the things that were discussed last year has already happened, and now we're faced with new risk, so-called risk, and a lot of talks that happened last year, practically speaking, has already happened, and the risk has already diminished. So the actual user protection is a backlash to the actual market, where the market has kind of resolved that issue by themselves. As you know, just for a case in South Korea, as you know, Korea has had a very unfortunate crypto events, such as, I'm sure you know, the Luna event, which is still ongoing. It has affected probably 2/3 of crypto traders in Korea. And also, you all know about the FTX event that happened 3 years ago. Half of FTX users were from South Korea, and their accounts are still frozen. However, a lot of the framework has been focused on those two events that happened 2 years ago, and currently, the market has cut up to a certain point where a lot of the DeFi products that have shown up last year and the year before have already dissolved or have been delisted from central exchanges. A lot of the traders have already caught on and did their own studies. So it's very interesting to see this catch me if you can scenario happening every year. And I foresee this happening everywhere, not just in Kenya, in Africa in general, but also in the US, Europe, and Asia as well, where the regulators they're going to come up with new regulations every year, trying to catch up, but then the technology is going to further distance from the regulations. So what that leaves is, as Mr. Kakai mentioned, such frameworks such as Sandbox, where the regulators are comfortable with startups trying out new things as long as they comply with the key regulations. And what South Korea has done this year is they've said, okay, we can't catch up with you guys, but we want three things, and three things you just have to comply. And number one is we have to comply with the the FATF AML rule, which is the KYC rule where the exchanges have and they're willing to be transparent with all their users. So not one user can you guys hear me? I think I just lost you guys there. Hello, Edward. Can you guys hear me? Obviously, we're trying to do live stream globally, live, being 6 hours apart. There's going to be some, okay, thank you. There's going to be some technical issues such as this. However, just going back to my thesis is that the government is asking for three things. Basically, number one is to not do an ICO, which is part of the user protection. Number two is to comply with the FATF rule, which is the Financial Action Task Force, and to do KYC for all the users, and to basically give all the information about users when they're asked upon. And thirdly is to comply with the tax, so basically pay up the taxes. And Korea has come up with a capital gains tax, which will be implemented from January of next year. So these are the three things that they outline as a baseline. Besides from that, they openly are engaging with the startups, the people in the scene, and trying to come up with the best regulation as possible. I think we've lost the main camp. Okay, we're live again.
Sorry, I think we had a technical hitch.
Okay,
but I believe we are back. Yeah, so apologies for that. I think some you had covered quite a bit on what's happening out there in other jurisdictions. I wanted to zoom in on South Korea a bit. And South Korea is one of those one of the most active countries actually when it comes to crypto trading. In fact, I found out that during the peak of bull run, the trading volume of crypto in Korea surpassed that of the stock exchange, which was quite surprising. I don't think we've seen that in other markets. So what are the regulations which are in place? I know last year they came up with virtual assets user protection. Is that in force, and how is that being implemented?
Sure. So not to get too technical, I think Mr. Kakai has outlined the key criteria for the regulatory framework to work and to coexist with the market. And interestingly, in Korea, as I told you, the market has exploded in 2017. The ICO boom, we saw a huge spike in trading volumes, and since then it hasn't declined as much. And when the regulators tried to regulate the trading, a lot of the traders went overseas. So that's why, as I mentioned, half of FTX users were from South Korea. Binance, OKCoin, OKX, KuCoin, all of these big exchanges, a third is Korean users. So the government is now saying, okay, I think we made a mistake, and let's invite them back into Korea and just tax them. And this is the thinking of, and this has been the thinking the past 2 years. And obviously, you guys mentioned, in order to tax it, you need to have a baseline. If you don't even have a category for the taxes, it's an oxymoron. So they came up with that the virtual asset service provider, which was about 2-3 years ago, and then they asked the central exchanges to make a database of all the transactions that happened 2 years ago, and they practiced that last year. And then they were supposed to implement that this year, but because of the general election, they postponed it to January of next year. So from next year, there will be a levy of capital gains tax of around, depending on the amount, around 20 to 24%, but very likely around 22%, which is quite high. But this is actually in line with a lot of the other capital gains tax. So even though the regulators do want to give a bit of a favorable tax, but because this is the first time that's happening, and they can't skew too much to crypto, even though they are pro-crypto, they do have to align the tax with other financial products such as futures, foreign U.S. futures, U.S. Stock investments, and FX investments. Well, we can't hear you.
Sorry. Can you hear me now?
Yes.
Yeah, I have a question on the taxonomy classification of virtual assets, and specifically doubling down to stablecoins. I mean, I've seen other Asian countries like Singapore, as much as they have a vast regime, they are starting to adopt a stablecoin specific regime whereby stablecoin issuers have to follow these stablecoin regulations issued last year by the Monetary Authority of Singapore in Singapore, and the Japan the same. What is the feel in South Korea, with respect to stablecoins? Are stablecoins sort of treated separately, or they are bundled up in the class of all virtual assets the same way Bitcoin, Ethereum are all under one asset class?
So, Mr. Kakai, you ask a very critical question, and this has been the biggest headache. And the reason is because the Bank of Korea has been working on a central bank digital currency for quite some time, and it's no secret. And they've also partnered with one or two of the biggest Korean internet providers in working to issue this token. For them to label a stable coin prior to issuing their own digital currency, they're actually putting limitations on what they can do. So you're actually kind of shooting your own feet before you even do anything. This is the reason why they've been postponing any guidance into stablecoins. Currently in Korea, you're not allowed to own a stablecoin in US dollars, and there is no stablecoin issued in Korean won. And the reason is because that falls under the FX capital market law. And in Korea, capital market is very, very strict. So if you If you send out more than $20,000, you have to report it to the Bank of Korea.
So you're saying, as a Korean, I can't hold USDC on any custodial wallet in Korea, USDC or USDT?
It doesn't exist.
Oh,
Interesting.
interesting.
Everything
How will they be able to monitor that? For instance, if I'm holding USDC as a Korean on my MetaMask, or USDT on my MetaMask, are they able? Does the government, is it able to enforce that policy that I should not be holding it?
So, because MetaMask data center is outside of Korea, there's no way for them to enforce access into the data. However, as I told you, because they were coming up with a tax regime 2 years ago, they enforced all the central exchanges to report all the transactions. So if I send Bitcoin out of a Korean exchange into Binance or MetaMask, that has to get reported, and that has to get recorded. And when the government asks for that data, the central exchanges has to provide that transactional data. So in a way, everything is on blockchain, but at the same time, the exchanges has to keep a double book where everything matches exactly.
Yeah. All right. So maybe back to you, Kakai, to look at what the virtual assets are, service providers bill entail. What are some of the components of that bill, and what should we expect?
Yeah, so from our perspective, the bill we drafted, the key components of that virtual asset bill was, first of all, Sam pointed out, taxonomy, understanding what is what, and understanding that will help inform the length and breadth of enforcement of this bill, defining exactly what a virtual asset is, and separating that, and also defining what a stablecoin is. For that, as we define virtual assets and we define stablecoins. That was number one, just making sure there's clear definitions for a token, which also forms under virtual asset, what a stablecoin is, what an initial a security token offering is, and Paul will call it initial coin offering, and so on and so forth. So number one was having a very comprehensive classification and definition of things, so that we know what the bill is exactly dealing with. Number two, in terms of definition, now after definition of the items, number two was definition of the players, defining who exactly is an exchange, who is an on-ramp, off-ramp service provider, who is a token issuer, who is a custodial service provider, and so on and so forth. And in defining that, we now are able to further narrow down and say, okay, this guy is eligible for license, this one is not. So we defined 4 key categories that are eligible for license. Number one, if you're operating an exchange that facilitates the buying and selling of virtual assets, or peer-to-peer swaps, or centralized exchange that basically facilitates access to virtual assets. That was number one. Number two, on-ramp, off-ramp service providers. These are people who will take your Kenyan shillings and give you stable coins, or take your stable coins and give you Kenyan shillings, vice versa. That was also a licensing category. And number three, we were looking at custodial wallet providers, and specifically focused on custodial services because of the the risk that comes with holding used as custody. So focusing on guys who are doing custodial wallets and just making sure that they fall under that regime. And number four, token issuers, because right now we are at this age of real world asset tokenization. We have a lot of very awesome and exciting real world asset tokenization projects, but these guys are unable to scale beyond because you can't even partner with an investment bank distributor of securities, because they'll tell you that product is not licensed by the CMA. We can't touch your gold-backed token, or we can't touch your affordable housing token until you receive CMA approval. So for us, it was important to allow people who are deploying gold-backed tokens, people who are doing affordable housing tokens, and any other real-world asset-pegged token to at least have a licensing category. To some extent, stablecoins usually are backed by real-world assets. So there's a highly likely chance stablecoin issuers might fall under this category, because there's 2 types of stablecoins. There's one that are actually backed by cash reserves in banks, but there's stablecoins that are actually backed by government bonds. Somebody buys government bonds from the National Treasury, then resells it in the secondary market as stablecoins. That is literally real-world asset tokenization. So that stablecoin issuer can actually fall under that category of a token issuer if it's a bond-related kind of stablecoin. So that is the second thing the bill was looking at. After number one, we said it's classifying of the assets themselves. Number two, it's classifying of the players themselves. Number three, defining who does what from a government perspective. Which regulator is responsible for, first of all, registration and licensing of virtual asset service providers? Who is responsible for stablecoins and monetary policy? Who is responsible for AML and CTF? And of course, who is responsible for tax? Given that we realize that, and I think as we pointed out starting out this meeting, virtual assets and the whole blockchain ecosystem is very disruptive to the point that there's always a new product every day, right? And if we gave all this power to one central regulator, it will be hard for this guy to keep up, because sometimes some of these products might spill out from their regulatory mandate. And that is why I specifically pointed Singapore and Japan, whereby you see virtual assets are regulated separately, and then there's a separate stablecoin, a parallel stablecoin regime being regulated by the Monetary Authority of, for instance, Singapore. So we have to develop a way that, of course, there will be a framework of regulating centralized regimes, but in the event things like stablecoins come up, NFTs, or something that is beyond this central regulator CMA, that can be able to handle. So we had to invent a joint regulatory authority. That means this is an authority that the guys from the Joint Financial Sectors Regulatory Authority are sitting in. So this authority will have a rep from the CBK, from the CMA, from the FRC, from the NIFC, and ideally it will be a one-stop shop for regulation. Imagine how neat it will be that if you have an exchange, and you've seen exchanges that have layers of other products. An exchange is doing exchange services, number one. Two, doing custodial services. Three, technically doing stablecoin payments.
So
four,
they normally
doing
have
lending, multiple
products,
services. So imagine if such a guy was to come and get regulated in Kenya, he'll have to run around across various regulatory agencies.
And I think that came out clear last year when one of the players came into the market, and quite a number of regulatory bodies came out and said, hey, this guy didn't consult us. Everyone said, hey, we've not given these guys up. So there was a lot of
there was a push and pull where one regulator is saying, I okay this guy, and goes live on press and saying, these guys are good. Then the other regulator is saying, no. So that is where we had to hack this mischief by creating a one-stop shop. So that if you come with a product, no matter how complicated it is, you'll find all these regulators in this one-stop shop. It's sort of like a buffet, whereby all meals are there. You just serve what fits you as you go. So that once you walk out of that room with that license, it's bankable. Nobody can ever dispute that license, because everybody had a chance of looking at it. So that was like a very big part of solving that push and pull across regulators. And this is very interesting because you see even the regulators, when they picked up the draft version of the bill, they formed a technical committee that is composed of guys from all these regulatory sectors. So that was an important part. The other important element we picked up and doubled down in the draft bill was consumer protection. Sam has given a very good illustration of a lot of FTX guys who still have their accounts frozen in South Korea. But I know, for instance, Japan was like the biggest use case or demonstration of how consumer protection works in virtual assets, because there was FTX Japan and there was FTX. So after the FTX collapse, everybody, 90% of guys who are using, actually 100% of guys who are using FTX Japan managed to sever their savings or their investments, because the Japanese framework was very comprehensive to the point where the FTX Japan MTF had been mandated prior to sort of have a reserve locally. So when they collapsed, the guys who were banking with FTX Japan were able to recover their funds. So the Japanese people who did not recover their funds were guys who are banking with the other FTX. So there's FTX Japan and FTX. So that was a very good consumer protection use case. In the traditional market, the Capital Markets Authority already has a consumer protection fund that guys who are doing securities, commodities, and trading usually deposit something, so that in the event their product collapse, consumers can recover something. We've also seen this in the banking sector. All banks have to maintain a ratio, a reserve at the Central Bank of Kenya, so that if a bank collapses, you'll get something. You might not get 100%, but it's better than nothing. Just a portion of 1%. So those were the key main things in the bill, and that was the reasoning behind a lot of
Yeah,
them.
there was sandbox framework as well.
Yeah. The sandbox framework. Sorry, thanks for reminding me. I'm sorry for forgetting about that. So the sandbox framework would fall under this joint regulatory authority, whereby if somebody has a product, they will come and onboard their product, the sandbox, and try out the product to a maximum of 10,000 people. And we are startups, so somebody can always switch gears very fast. So the idea behind the sandbox is before you commit to a licensing categories, you are able for a period of 12 months to switch gears as much as you want and co-work with regulators up until you settle in a licensing category that fits you. And interestingly, now that you've mentioned licensing categories, and this has escaped me, but it was a very important thing. A tiered licensing category. By tiered, I mean, and as I mentioned, some of our players have a range of products. Somebody is doing exchange. You can stake on the exchange. You can DeFi lend on the exchange, on-ramp, off-ramp. They're doing a range of products, and one licensing category could not fit them. So we classify the license class A, B, C, and D in such a manner that if somebody obtained the class A license, they can be able to do all services under class A. So if somebody walked in and got a class A license, they will be able to do exchange, custodial wallets, lending, token issuing, everything. Same thing. So if you move to class B, you do class B and below, class C and below, D and below. So that really will help allow mitigate this risk of confusion of doing a service that you're not very sure you're licensed for. Yeah.
Right. Super. I think we have a couple of questions on the comments. We can pick this one from Waitito James. How can African regulators strike a balance between encouraging innovators and protecting consumers? So I think Sam, you can take that. And as you take that, perhaps Kakai, you can take the one on KYC AML from Lucin Joki. She's asking, what are the current KYC AML regulations for crypto businesses in Africa? I think with Africa, if I can pick this one, it's very segmented in terms of regulations. We've seen countries like South Africa, and I believe Nigeria have some sort of guidelines around that. But in Kenya, for instance, we are not there yet. Mauritius, I think they have something already enacted in place. But this differs from jurisdiction to jurisdiction. Maybe Kakai will mention on that. I don't know if we have any other question that we can pick. Maybe we can take those ones. Yeah, because of time, we can pick those ones. So Sam, on striking a balance between innovation and consumer protection.
Sure, and this is a great question, and something that, because I am involved in a startup and I do invest in crypto startups, at the same time, I advise to governments and I speak with a lot of regulators, not just in Korea, but globally. And the number one issue that I always have is that it's two very opposing sides. As I mentioned, that's playing catch up. And if you think about the whole purpose of crypto and blockchain, why it was born, it was to actually break away from the current system of banking. It happened during the subprime banking crisis. And the reason why they made Bitcoin was so that, we can move away from banks. But now we are working together with banks, and and we have to sit in the same room, and we have to, come up with new regulations and new framework for us to work together. And I'm sure this is something that has happened in the last 12 years. And, it's come to a point where, like you mentioned, the regulators can leave this just alone. And, it's gotten too big. If you look at the trading volumes, people participating, the startups in the scene is, this is one of the fastest growing industry in the world. So how do you encourage new developers, new startups, new investors to keep coming into the market and grow the market at the same time, protecting consumers? And I've seen this in multiple countries where, and I foresee this happening in Kenya and other African countries as well, is in the beginning, a lot of the regulators don't want to touch it. And the reason is because there's too much to learn. There's too much risk for them personally. And if something happens while they're on that seat to take the responsibility, they have to take whole responsibility for something that they don't know. And this is the saddest thing that anyone can face. So a lot of the time, and the same thing happened in the US as well, as you know. It took the US almost 8 years for them to even sit down and talk about this. And once Gary Gensler became the chair of SEC, things moved quite quickly. But if you look at how SEC became very vocal, in the beginning, we didn't think that SEC would be that vocal. But once they found out that this is the growing industry and they needed to be vocal, they started competing with other committees, such as Futures Committee. They started competing voluntarily with other committees and voicing their voices. And this is what's happening now in Singapore, Japan, and Korea. Is 5 years ago, every committee said this is irrelevant. This is we should ban this, and everybody should not touch this. And this is what happened in Kenya with with that letter from CBK. And then later, as people move on and people become a bit more aware of the technology and also aware of the potential of the technology, is they start studying it and then they start trying to regulate it. I think this is the phase where we are now, the second phase. The third phase, where we haven't gone yet, is where we come to a point where the consumer risk, are self-protected by the technology. By that, what I mean is if you look at 80% to 90% of the DeFi projects currently, including Luna, there is no sense of consumer protection, because to them, consumer is their users. So basically, for them, they don't need to protect their users. As for the government, it's a different issue. Besides from paying tax, the users don't pay anything to the government. So I think that mentality from the technology background is changing and shifting, and they're realizing that. So if you look at the recent DAOs, for example, a lot of the new smart contracts that are being developed, they're starting to have chapters on protectionism, protecting consumer, protecting users. And as you mentioned, the whole word reserve fund didn't exist 2 years ago. And now every exchange just has a reserve. They don't like, the whole framework of reserve goes up and down. Obviously, 8%, some cover 50%. Binance, they say they cover 100%. Nobody knows. But I think the third phase of this is that consumer protection is going to actually come from the technology, where the government, the regulators, can be comfortable with the technology. And this is where I foresee this happening in the next 2 to 3 years. So I hope that answers your question.
Yeah, thank you.
Can I double down on consumer protection?
Sure.
So just to double down on the consumer protection, to Sam's point, consumers usually, even in the traditional financial space, are usually classified either as retail consumers and institutional consumers. And you'd notice government is usually very vocal in protecting retail consumers. These are the common mwananchi, as we call them in Kenya. A random campus student who only has $10 or $100 to spare, and they do not have the knowledge, the know-how, the experience, the expertise in investing in some of these very high risk. So that is why government consumer protection, even out of the crypto sphere, even in the normal securities commodities market space, very keen on retail consumer protection, because they have no one apart from the government to protect them, as opposed to as opposed to institutional investors and institutional consumers like the BlackRocks and hedge funds and private entities that have enough lawyers, enough teams and expertise to at least help them figure out the private arrangements. And that is why when you see some products, if you look at some stablecoin products, apart from USDC and the USDT, some very high-end stablecoin products like the backed B101 issued by BAK Finance or from Switzerland is focused on those kind of institutional consumers because it's easy to get into a private arrangement with institutional consumers, and you'll see some of them having a pre-qualification criteria for before you participate in the purchase of these tokens. Number one, you need to have a minimum of $100,000. Number two, you need to demonstrate your knowledge and expertise. They sort of do due diligence in their own consumers so that they satisfy themselves that the consumers are aware of the risk. But now that only helps them protect themselves as a company from questions surrounding consumer protections by strictly limiting the product to institutional investors. But then again, there's this big question of now who, in case somebody is rolling out the product to retail consumers, how should such product be structured to protect them? Because you're not negotiating with them, you're just giving them a product to consume. So that is one very big factor that the capital markets was looking at. They're looking out for the retail consumer. Now, to my point, or to the point or other question on anti-money laundering and counterterrorism financing, yeah, as you answered, you put it rightly. There is no regulation of ML and CTF that is specifically dedicated to virtual asset service providers or virtual assets. Usually, when there's an industry that has emerged, the Financial Reporting Center is supposed to do an analysis and issue an advisory note or a technical paper or guidelines guiding that industry. So, for instance, when the digital credit providers lending came up, or when the fintech money remittance industry came up, after the regulations, the FRC sits down and issued guidelines called ML and CTF guidelines for this industry. ML and CTF guidelines for, let's say, lending industry. ML and CTF guidelines for payments industry. So they have not done that yet for virtual assets. What they have done is the survey we did with them last year, the pulse check or risk analysis. They did the risk analysis and they said, yeah, of course, yeah. The recommendations were this need for monitoring and evaluating the ML and CTF risk parameters around the space. The reason why guidelines for sector-specific guidelines are important, and the reason why the licensing is important, is for reporting. To some extent, virtual asset service providers do not have a reporting mandate to FRC per se, but with a clear guideline and clear reporting framework, FRC can call up a report, ML, SRT report, a risk report from a virtual asset service provider. It can develop standards on how virtual asset service providers KYC. So what existing virtual asset service providers do in terms of ML and CTF is to some extent what I can call self-regulation.
Right.
You've tried registering a lot of these exchanges. Given that they are aware that there's a global risk, because ML is a global risk, they have some sort of gone out of their way to develop AFTF compliant ML parameters. You'd require to scan your face and upload your ID and all that. So they've gone out of their way without FRC asking them. Right. They have demonstrated goodwill and gone out of their way to sort of comply with global standards like AFTF. So in as much as there's no local ML policy specifically for virtual assets, any virtual asset service provider that is complying with all AFTF standards to some extent, I'm fairly certain that whatever guidelines FRC develop, they will be easily compliant, plug and play, because AFTF standards are already tried and tested in terms of virtual assets ML risks.
Yeah, and I expect a lot of providers will also be looking at industry standards from other jurisdictions as well, because at the end of the day, they are pretty much the same across jurisdictions. Yeah. All right, guys. I think due to time, we're going to wrap up here. I see we have a lot of questions in the comments. Unfortunately, we are not able to go through them all. So what I could ask you guys to do is perhaps drop them in our channels. So we are on Twitter, we're on Telegram. Kaikai, I believe you can be reached through LinkedIn, Twitter as well.
Yeah, LinkedIn, Twitter.
So drop those questions there and we'll do our best to respond to them. Thank you so much, Kaikai. Thanks for your valuable time. Sam, asante sana. Really appreciate for this, and hoping we can continue with these discussions in near future.
Sure thing. Thanks for having me, guys.
Yeah. All right. Thank you, guys. Have a
Okay,
good
quiet.
one. See you in the next one.